All right, we are going to go through whole life insurance and have a laser focus in this video on the cash value benefit. So when we think of a whole life insurance policy, typically what comes to mind? A policy where we purchase a death benefit, we often have a very high premium, and eventually cash value builds up. But then on the other side of the fence, you may have heard that many individuals, many ultra wealthy individuals, big banks, corporations have used whole life insurance and high cash value life insurance forever and continue to use today because it is one of the best areas they can position money. So why do we hear two different sides of the fence? Polar opposite. We hear stay away from whole life insurance, worst area we could go, period. And then we hear this is the best area you could position money. Why is that? Well, when we look at the traditional whole life insurance product, and what I mean when I say traditional whole life insurance is a policy where we are just buying a death benefit. We're going to show an example here in a second. Typically, it is very expensive. We pay premiums for a long period of time. Point number 3 is the most important one. It is a life insurance policy first. That's what I am purchasing. And then eventually, cash value builds up as time passes. As I continue to pay premiums, cash value builds up. And this is the type of whole life insurance, this type of structure or design that Dave Ramsey and individuals like him have a field day with. That say, stay away from it. It's junk. It's very easy to diffuse. Quick example here. Here is a 40-year-old male presented $100,000 per year going into a policy, and all of that $100,000 is allocated toward the premium. So look at the cash value in the first year. He paid in $100,000 and had $3,300 to show for it. What's highlighted in yellow is his break-even point. At this point in time, he's paid in $1 million and he has $1 million. Now he has a substantial death benefit, so it can potentially cover a need there, but from a cash accumulation standpoint, is this the best area to position money? No. I would strongly state no, and we at IBC Global design policies for maximum cash value. It's how we drive our business through selling life insurance, setting it up for individuals. Then we've got high cash value whole life insurance, which I just want to iterate something here. This is the exact same product, often with the same company. If we're looking at different companies and such, the design has to do with it, which we'll get into in a little bit more detail here. But here's often how it is approached. Instead of just an expensive product, it is a savings asset with life insurance as well. We'll often discuss the core benefits of a life insurance policy, a cash value life insurance policy. Around the cash value, it is a safe, liquid, tax-free area to position money that has a unique loan feature. And to touch on that very quick, the loan feature, a unique feature to a cash value life insurance policy is that once a dollar passes through a policy, regardless if I just let that dollar sit and grow, or if I loan money out, if I borrow against it, I will continue to earn dividends and interest on my entire cash value as if I never touched it in the first place. How that works, it has to do with the loan interest, how the company collateralizes my death benefit. We've got plenty of content on that as well. Feel free to check it out if you'd like. So, first bullet point, savings asset with life insurance attached as well. Premiums are extremely flexible. We're going to demonstrate that in a little bit or explain that. Cash value first with life insurance second. Now, it is a life insurance policy, so no matter what happens, I do have a life insurance death benefit. But when we look at point number 4, the 1%, big banks and smaller community banks, corporations, wealthy individuals, business owners, have forever, and especially today in today's environment, put boatloads of capital into, boatloads of their money into cash value life insurance. And often their goal or intention is to grow a cash asset, grow the cash value, and have the death benefit as well. So in doing that, what happens here is you can turn this, the first example we saw, into this. Here you see a policy with the exact same company, exact same 40-year-old male, exact same out of pocket, $100,000 per year for 10 years. And this works if it's 10,000 or if it's a million. It's all relative. Look at the difference though. Instead of paying in $100,000 and having $3,300 to show for it, he pays in $100,000 and has 88% of his payment right off the bat and a $4.25 million death benefit. Beginning year 2, he pays in the same 100 and the cash value grows by more than what he pays in. What's highlighted in yellow represents his break-even point. So again, same company, same individual, same out of pocket by the consumer, yet a drastically different outcome. This really has to do with what's called the policy design. In fact, let's get into that right here. So again, this all goes back to the cash value benefit. These guys do it for these reasons. Why or how is it set up? That example you just saw, identical out of pocket but very cash rich. How did that work? Well, it has to do really with what is called the policy design. And this is my favorite part, one of my favorite parts about cash value life insurance. You know, when you pay any amount of money into a life insurance product, you, the consumer, the policyholder, can actually choose where your money goes, right? Which doesn't sound like life insurance in the sense that when we hear of a life insurance policy, typically what comes to mind? I pay a premium, I have insurance, and if it's a life insurance policy, when I die, money gets paid out. And then when I state you can actually choose where your money goes, much different, right? So when we pay any amount of money into a product, here's the key element right here. You can choose how much of your money is directed toward the insurance premium, and then how much is directed into what is called a PUA, that stands for Paid Up Additions Rider. English translation to these, the premium I will refer to as the initial insurance expense, and the PUA rider I'll refer to as a cash dump-in. So, like any product, if you're putting any amount of money in, we want to understand the relationship of our dollar. How is it actually going to work? So with these two areas, let's use a round number. Let's assume you're going to pay $1,000 per year into the premium and $1,000 per year into the PUA component. What is the relationship of those two areas? So first and foremost, with the premium piece, I pay $1,000 in. What happens? You will see in the first year, just like that example, where $100,000 went in with the traditional policy, he had $3,300 show up. 0 or a very small portion of your payment show up in cash value, and sometimes for the first and second year. This depends on the product. The reason why is that the insurance company is going to overcharge me for the cost of insurance, or call it the death benefit up front. Now, when we hear the word premium, typically what comes to mind, expense. Now, with that said, once you hit the third year, second or third year, depending on the product, you will find your premium payment does begin to come back to cash value, and that's money you can access. Begins to yield the guaranteed rate, begins to yield dividends. Things accelerate, it becomes more attractive. But in the first and second year, nothing shows up in cash value, and I have to make up for lost time. Versus the PUA component, why we call it a cash dump-in, is if I pay in $1,000, I'll see approximately $1,000 show up. It might be 97 to 98% companies, most companies typically have a small fee associated with this rider, but you will see for the most part that show up in cash value, and that is money you have access to and begins to yield both the guaranteed rate and any dividends. Now the term paid up additions represents the fact that it purchases us paid up additional life insurance. What I mean when I say paid up is that payments are not required here, unlike premium dollars. So it's very flexible. We can decide to add money into this component, or we can choose not to add money into that component. We can make it very flexible. For example, if we go back to that $100,000 example, the good looking one, we have a premium of just about $10,000 in this example. With this particular product here, how we designed it is the policy owner can literally commit to the $10,000. He can pay that only on his anniversary date. He could even break it up over 12 months and pay what would be about $830 per month towards the premium. And then 100% at his leisure, he can elect to add more funds into PUAs. So about another $90,000 up to the 100 per year. So he commits to a minimum amount, has the ability to add more, but he's in no way, shape, or form committed to the 100. Very flexible in that respect. A lot of people like that. A lot of bigger banks, corporations, I shouldn't say banks, corporations and wealthy individuals typically take that approach. Banks usually just fund it with a big lump sum up front. So let's continue on here. Because on the design, the question we always get is, okay, I don't care about the death benefit. How do I put 0% of my payment here? Whatever my payment is. Can we go that aggressive? The answer is no. We have limits we have to deal with. First, you've got the insurance company limitations. And all companies have different limitations. Some will allow you to drive that premium as low as typically between 3 and 5%. Some smaller companies do that. If you look at some of the larger mutual carriers, larger major mutual carriers, the big four that we prefer, I should say, they will typically allow you to drive that as low as about 10%. They all do not have a clean 10% ratio. It depends on the company, but that's just good general information. So you see this 1090 or 1090 split. What that would mean, if we stick to this example here, is if I had a $1,000 premium, that means I would have the ability to add another $9,000 into PUAs, accelerating my cash value, which will begin to compound. I have access to, picks up the pace for everything, which gives me a total of $10,000. Now, some companies will allow you to put 10 times your base premium, so it might be 11x again, and that means all companies have different rules and such there. But it gives you a nice overview in that respect, where I can commit to 1,000, have the ability to go up to 10,000. So that's the first limit. The second limit has to do with this guy, an MEC or MEC. That is an IRS limit that determines that the IRS really puts in place on life insurance. So why so many people are attracted to life insurance is really the tax benefits on the cash value. If I do everything right, I can use it tax-free. However, if my life insurance policy becomes a modified endowment contract, the tax benefits are out the window, in the sense that my money will still grow tax deferred, but anything I access in respect to the gains, I have to deal with ordinary income tax and a 10% penalty tax. So how I prevent that is every policy has what is called a MEC limit, which is exactly what it sounds like. It's a limit that determines the maximum amount of money I can pay into a policy per year without triggering a taxable event. And here's the beauty of it. We can actually set that limit wherever we want. You'll find that it has a direct relationship to an individual's age and total death benefit, the total amount of life insurance on a policy. So going back to the drawing board, right? You've got the benefits, traditional whole life, which is what a lot of people run from. They see whole life and say, I want nothing to do with that. this guy doesn't like it at all. But then we hear stories and see firsthand people with money putting a ton of money there, which, by the way, what they practice, it's all ratios. An individual putting in $1 million per year or $5,000 per year or a couple $100 per month, we can almost design it in the same manner where we will have high cash value immediately and long term. So it's really going from this to this. And the last thing I want to touch on is in respect to flexibility, right? We talked about how to adjust your payments up and down, but many individuals hate the idea of being committed or having just the thought of paying into a policy for a long period of time. So here's the same 40-year-old male with the same million, same company, same product, paying it in over 4 years. And he could do it in 2 years if he wanted, but 4 is most efficient. Gets his money back between 3 and 4, pays nothing, not even the premium from that point forward. Cash value continues to grow. And if we are told, look at the guarantees, which is always good to look at the guarantees, a worst case scenario environment, this attests to the design. Here we see an example where it is the same product actually that we just saw, but illustrating just the guarantees. Look at that, breaking even between 5 and 6, strong cash values, has the option to continue to pay, but he does not. And when looking at the guarantees, this is the annual internal rate of return, what he's earning year over year on the product. Guaranteed. If we don't trigger a taxable event, we can use that tax-free. Compare that to a safe asset like a bank account, money market, CD, whatever it might be. Oh, and I have life insurance as well. So mainly, this was meant to attest to the benefits of whole life insurance when designed for high cash value, the flexibility, and really how to design it. That's the key. If it's designed properly, it's very flexible, and we've got rich cash values from the get-go. So, as always, I hope this helps. Reach out if you have any questions or would like to see custom samples yourself or work with our company. We'd be happy to talk to you, and I'll talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.